Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Volatility Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital or Sunpoint Investments.
So Matt, before we get started here, I just wanted to let the listeners know you're kind of a big deal on Samsung podcasts these days. I don't know if you knew
Samsung podcasts?
Yes. Did you even know there was a Samsung podcast?
I think I bought a Samsung product in the last, certainly in the last 30 years. How big on Samsung podcasts
so we have this weird thing. We obviously are not getting tens of thousands of downloads. That might shock the viewers given the quality of the content here, but we don't get tens of thousands of downloads every episode. But I was looking back at one of our episodes, I think it was the ARC one or something, and it had 20,000 downloads. And I was like, why does this have 20,000 downloads and all the other ones don't? And it turns out the source was Samsung Podcasts, which I don't even know, from what I figured out, there seems to be some sort of Samsung Today app that is an app that comes up on your Samsung phone that has a bunch of stuff in there. It's not necessarily a podcast app. And I guess we must have been featured in there because we got tens of thousands of downloads on an episode. And all of it is basically if you look at our history now, it's 90% of our history now is Samsung podcasts, and Samsung Podcast has a 0.1% market share in podcasts. So anyway,
hey, you got to corner the market somewhere. If the Hunt brothers taught us nothing, that's wild. I think my mom might have a Samsung phone. What are the odds she's all 10,000 downloads?
Yeah, maybe she's running a bot or something over there.
Of course, she's running a bot without knowing she's running a bot.
If there ever is a Samsung podcast event, I don't know if you ever remember David Hasselhoff when he used to go to Germany.
I mean, who could not forget the Hoff?
Yeah. So when he went to Germany, there was people everywhere. That's going to be you if there's ever a Samsung podcast event. So
I can't wait to travel to Germany next. It's actually been 20 years since I've been in Germany, but I can bring my Samsung stardom all the way home.
Before everyone stops listening to us because we're talking about nothing that we're supposed to be talking about, we probably should pivot to our discussion of risk today. And this is a cool topic to talk about because everybody thinks about return and they think about risk. But the big difference is return is very quantifiable. You can see your return. But when you think about risk, yeah, there's ways to quantify risk, but risk can be measured in so many different ways. And, risk is not just a function of what the investment products you're in does, but it's also a function of how you react to it. So there's so much going on there. So I thought it'd be interesting for you and I just to kind of talk. I could talk maybe from an investing perspective and you can talk from a planning perspective about this whole idea of what is risk.
I think that's a great idea. I know, say the name of you wrote a post on this, and that's part of why we decided we should do this today. What's the name of that classic Jack hit post?
Well, it was a very innovative title. It was actually called What is Risk? So obviously I used ChatGPT to optimize that thing.
Fantastic. Well, the things that we can quantify, which are a huge part of both building investment models, definitely building quantitative investment solutions, but also in the modeling out of plans. And what's crazy is the language, the word we use to talk about risks, the language is different. It's that whole map is not the terrain idea again. We can talk about this stuff, but that's not the experience. And when we think about the experience of risk, that doesn't even track all the way back to just having the right words to actually describe with what it feels, what we go through when we put it on. So stoked to have this conversation. This is a huge topic.
So if we think about it at a high level, I was trying to think the shortest definition of risk I could possibly come up with. And to me, it's almost it's got to be a function of the percentage chance that I won't achieve whatever the goals I'm trying to achieve are. And, there's a lot of different things that could come at me to prevent me from achieving those goals. So it's kind of a wide thing, but I almost think about it from that perspective, the chance I won't achieve whatever it is I'm trying to achieve.
Do you think of a difference between risk averse and risk aware?
Yeah. I mean, I guess there's a difference in terms of how you react to it, right? I would guess everybody's aware of the risks, but the people that make the wrong changes, the people that do the wrong things in response to the risk, that's where it really comes in and becomes really important for, a portfolio or an investment plan.
I think this idea of like risk averse means I don't want to take this thing on. Risk aware is I have some understanding of the variability I'm taking on. And when I look down all these things, I keep thinking of that too. You have to understand the beginning of risk so you can choose if it's a type of risk you even want to entertain. Does that track with you and how you think about it from investment land?
Yeah, no, I think that makes a lot of sense. I think that's one of the places where planning and investing probably come together on this.
Yeah, there's definitely a ton of overlap there. Well, take us down this list. Let's go through these.
Yeah, so like I think a good thing to start, and we're going to talk about this in a lot of ways that can't be measured, but just thinking about some of the definitions of how you could define risk. And the first one on the list here is the one that Warren Buffett would tell you is not a definition of risk, but I think in the real world actually is to some degree, and that's volatility. And the people in my world will use things like standard deviation, but even if, we don't understand that concept in full, the idea of volatility is something anybody understands. The idea that I'm being put through a very rough ride to hold a particular asset is something everybody understands. So I think that's probably the most common definition. Obviously when you go into like the quant world and we're running, statistical things and stuff, we need some sort of number to measure risk. And so we're going to use volatility. But I'm interested, how do you think about that in the real world?
So I think this idea of there's a difference between expecting risk and when you're experiencing risk and when you've like missed or dodged any of this. So we think in terms of just like pure like volatility, we just are asking the question, and maybe this is the point. Getting on the roller coaster is saying like, I accept the risk that I am about to take. Getting in the slow lane of the highway, there's a risk somebody could bump into me or something bad could happen. I'm driving on the highway, but I know I'm in the slow lane. I know I'm not doing 90 trying to get around the big rig, whatever. So in the planning world, when we think about like volatility, this really boils down to just understanding variance, understanding how much up and down is really possible in the scenario we're putting in front of us, and then understanding the when does this matter? Because if I'm getting on this thing, I have to have some idea of when the most extreme readings I'm possibly expecting could show up under my nose. And once you understand when they show up, you have to then understand what to do about it. Does that make sense? Or how do you think about that aspect?
Yeah, no, I
the
think
timing
that's true.
of realizing it.
Going back to like the point about Buffett before, like Buffett always talks about how volatility is not risk, and he's both 100% right and 100% wrong at the same time. And the reason he's 100% right is if you're Warren Buffett, volatility is not risk, because Warren Buffett could literally care less about volatility. It does not impact him in the real world in any way. Like as long as he doesn't lose his capital, he's going to keep going.
Yeah. If your timeline is infinite, which Buffett loves to say, so if the timeline is infinite, then when doesn't actually matter, because you're never concerned with when the volatility is occurring because your timeline is infinite and you've already made the decision. For those of us who don't have an infinite timeline, whether that's our kids' college savings account or it's, the money for our retirements, those have whens tied to them. So we actually have to care about volatility in a way that's different from what Mr. Buffett's trying to tell us.
Correct. And also behavior is the other part that comes in the real world that Buffett doesn't care about. Like Buffett's behavior in theory is perfect. Your average investor, you and I can't have a client that like loses 90% in an investment and say, well, volatility is not risk, and hang up the phone and, go back to what we're doing. Like they're going to get rid of us. They're going to fire us. They're going to panic. They're going to abandon their investment strategy. So you have to bring in the concept in the real world. You have to bring behavior and risk and volatility together. And that's why volatility to most people is risk, even though it's not to Warren Buffett.
Every time either of us gets fired, we just send a case of cherry Coke and a box of C's candies and all is forgiven, right?
It would be great if that would work.
If only. We've got a lot to learn apparently here, Jack.
So yeah, and I had a few others in the article that I think we should go through in terms of how people define risk. And the second one would be one Buffett would probably agree with a little bit more. And that's this idea of permanent loss of capital. So, and I don't know how much explanation that needs, but obviously, if you look at the probability distribution of any given investment, and part of that probability distribution is I will have zero, then obviously that's an important thing for you to consider. Even if that's maybe not a high probability, if it's a probability that exists, that's an important thing to consider, because obviously once you've lost all your money, we talk about the rules of math are, if you lose 90% of your money, you've got a 10x it to go back up. But if you lose 100% of your money, there is no multiplier that's going to get you back. So definitely this is a measure of risk. And, thinking about could I lose all or most of my money, I think is a very important thing to think about when you think about any investment.
I always think about permanent loss of capital, or just permanent loss in general, is you multiplied next to zero is still zero, right? To your point. That can mean, in the financial planning sense, that can mean you're dead. That could mean the type of capital that we're talking about, it could be human capital, it could be any other type of capital besides financial capital, is no longer available to be played forward in the future. And that makes this a really important risk to discuss. The portfolio explanation to deal with this, besides understanding volatility and variance in general terms, this is really why we diversify, right? It's this idea that even if we're wrong in a few places, even if we're completely wrong in a few places, we have ways to survive. When we look at the venture capital model for investing and funding startups, nobody ever just takes everything and bets it on one potential startup or one idea. Well, maybe somebody does, but imagine the extreme scenario. And we do financial planning work with some of these people where they're founders. They've got something, they've got a substantial both piece of their nest egg and a huge bit of their future on every side, financially, identity, socially, spiritually, that this thing is going to play out. Diversification means if you have a complete loss, if you get zeroed anywhere along the line, what are you going to do to survive around it? Because it's a hole. Permanent loss is a hole that gets blown in your ship. So you need a plan so that that hole doesn't sink you. This term in that way is, I don't want to say it's more important than understanding volatility as variance, but it's way more real in grounding you to a scenario where we say, what if we just took this option off the table? Really powerful, really, really powerful.
The VC example is a great example because thinking about permanent loss of capital, not at a portfolio level, but at an individual investment level, like that's a great example where those guys know probably 5 or 6 of every investment they make are going to go to zero. They're going to permanently lose their capital, but the structure of what they're doing, they also know they're going to get, 100x on some of their investments. So built into what they're doing, they understand permanent loss of capital on individual positions is part of the deal. Now you get into public equities, you're doing like a large cap strategy. You can't do that. Like if you go to 0 on 5 of your 6 positions, it's just not going to work out. You're going to have major problems on your hands. So it's not like permanent loss of capital, like in every position has to be important, depending on where you're at, but definitely thinking about it in terms of like, could this whole thing fall apart on me? Could I lose all my money? Is very important, I think.
I think, like so many things, it's also super useful to take these ideas and take them to extremes. So even if somebody is not an investor in, venture funds, understanding when I have extreme volatility and I have an extremely high chance of permanent loss of capital, and I put those together, well, what do? I hold more things and I have some other stuff that's an anchor. So if a bunch of this goes wrong, because extreme volatility can lead to permanent loss of capital, can I have one of those pieces of that extreme volatility offset the entire loss and then some? And if we start from that really extreme understanding, then we can track back to your point into your, large cap US stocks or into a singular allocation and go, okay, I think I've taken permanent loss of capital off the table when I buy like a US large cap index fund. Not all of these companies are going to go to zero, at least not at all at once. However,
Doom and gloomers would disagree with you, Matt.
Well, we'll save that for that next investment product we're both thinking of launching.
Our doom and gloom episode, we'll save that for that.
We'll save it for that one.
Then.
But the idea then becomes, again, if we start from that point of, if you think in like venture terms of extreme volatility and the risk of loss of capital and how that plays into the capital to be gained, now we can go, okay, I have much lower risk of permanent loss, but I still have a variance problem to solve. How do I want to think about optimizing from both directions? And I think your article gets at this. This is one of the things when I see these oversimplified or somebody just picks one side, you lose track of planning in the real world if you only think of volatility in terms of variance, or if you exclusively think of volatility in terms of permanent loss.
It's like everything in investing. Like these days in the world, everybody wants to be like black and white with everything, but everything is nuanced in investing. You've got to be able to look at it from a bunch of different ways. And that was kind of what I was trying to get at with the article is like, there's no answer to this. Like if people are going to go read my article and think Jack has solved what risk is, Jack has not solved what risk is. Like it's in the eye of the beholder. It can be defined. There's so many different things going on. And this next one kind of gets into that, because in the world I live in, this is the most important risk, I think, which is, we run very, very focused factor strategies. And the most important risk in our world is not that the market's going to go down a lot. I think our investors understand if the market goes down a lot, equity portfolios are also going to go down a lot. The biggest risk in our world is in order to try to get an excess return in the world of factors, you have to deviate from the market. And when you deviate from the market, this can look ugly. It can be years where you're significantly behind. It can be multi-year periods where you're behind the market. And trying to align people who can stick with that is like the biggest thing we have to do, is trying to get investors on board who understand what the ride is going to look like to sort of get to the end game we're trying to get to. And so for me, like O'Shaughnessy talks about the 2 points of failure, one being, you're going to panic when the market goes down, and two being, you're going to panic when you deviate from whatever it is you judge yourself as a benchmark. In my world, number two is way more important than number one. I don't know how you look at it in your world, but to me, this is everything for us doing what we do.
So I think this goes back to this point of being risk aware as opposed to risk averse. So anytime you're saying, if you decide you're comfortable with S&P 500 levels of risk and therefore low odds in an index fund of permanent loss, you are aware of at least the idea of the risks that you're taking on. If you're going to go do concentrated value and now you have relative underperformance risk as well as relative outperformance risk, that's why you're doing it. But you should be much more risk aware of what those things are. I think when we've talked about in a couple of the ETF like focused episodes we've done before, where we've deconstructed quantitative or systematic strategies for building this type of stuff, like there's a huge difference between doing the Joel Greenblatt, I own 10 value stocks and whether or not I mix in quality to do this thing, and owning a 30 stock portfolio that has a value focus, let alone one that owns 100 stocks and has a value factor tilt. Those are all very distinct levels of risk awareness in making that choice. The greater you are aware, the greater you can tilt your own behavior to why you're going to do this and why you're going to stick to it. The less you're aware, or the less the person selling, offering, helping guide people in and out of these strategies is aware of how they're positioning and explaining it, the more everybody's getting ready to get disappointed.
Yeah, this is, in the real world, this is really, really hard to do, to measure this, to judge this. And we'll talk later about ways to like measure it or ways we try to. But like if I'm talking to Matt Ziegler,
not just hard, it's impossible to do. Right. It's just, can we have an open conversation about it for when it evolves, both fortunately and unfortunately in our laps, right?
So like if I'm talking to Matt Ziegler and if I have like a hypothetical investment strategy and I'm telling you, all right, here's my value strategy, it might outperform the market by 2% a year, but here's all the ups and downs you're gonna have to take. Here's the years you're gonna be 10% behind the market. Typically you're gonna be like, oh yeah, no problem. Like that sounds great. I see the 20-year chart you gave me. That's fantastic. I'm going to handle that. No problem. And then as soon as you start underperforming, you're going to be calling me up. Like we got to close this thing out. And like, that's the hard thing, is like, how do you trying to judge this in advance with people? I mean, some people can absolutely do this and you don't have to say anything to them and they get it. Other people, you kind of coach them and you get them there. And that's, our investors pretty much fall into those two camps. But then there's a lot of people who think they can, but then sitting there on the ground when it's happening, when value's struggling for, an extended period of time, they can't really do it. So it's really, really hard in the real world. And I could talk about some of the ways we've tried to do it, but it's really, really hard in the real world to figure this out.
It's impossible to figure it out. And this is the funny thing about taking risk in the real world is taking risk so it's just like having a business partner. It's just like understanding that you're going to be exposed to stuff you didn't even know you should be exposed to. You brought it up at the beginning of this episode, and this is a perfect example of it. What were the odds making a podcast, making a YouTube channel, whatever, that Samsung would have decided to give us some outrageous number of downloads? Like, was that on A, did you even know they had a podcast player? B, did you ever expect to be top of the old Samsung charts?
Yeah. What are the odds that something that's 0.5% of the podcast market would be for like a week would be like 90% of our downloads. If you do the math on that, it's probably not too good.
So inside of that, the only value of so number one, we were not risk averse in making the episode and doing the stuff that we do. We're very much like, okay, we'll put ourselves out there. I'm willing to, look like a clown once or twice on the internet. I've done worse. But then to be risk aware is we know there's the downside risks. We've put out duds of episodes. That's just that is par for the course in this business, if this is even a business. But then the flip side of that is you give yourself exposure to that upside optionality and whatever else happens. Now, it doesn't mean we're going to go turn around and really go after that Samsung podcast market. Although if you're out there listening, thank you so much. Please tell that again. But this is the embodiment of risk with business partners. We're joking at the beginning of this episode talking about this, but any relationship where we're putting risk on, so long as we're not averse to the types of risks that this is putting on, our ability to communicate around that is literally everything. The minute you lose the ability to intelligently communicate around the risks that you are at least semi-aware you're taking, the whole thing's going to hell.
Yeah. So in terms of like going back to like how we try to deal with this, like I'll see what you think about this, but like the best thing I've come up with is, so we created this, and this is why I'm like the worst marketing person of all time. I think to some degree, but like we created this document, which is effectively like, if you invest in these types of models, here are all the horrible, awful things that'll be happening to you over the next 10 years that you will have to endure in order to achieve what these models can achieve. And so, we talked about bear markets, but we primarily talked about like how often you underperform and the degree of the underperformance and how long the underperforming periods can be. And so I'm sure that's not something you want to be putting in someone's hand when you're, through the marketing process of bringing them on board. But like, it's so important with these things. These things are of no value to you if you can't stick with them. Like, and that's true of any investment strategy. Ours are on the extreme because they're more focused, but any investment strategy is not of value to you if you're going to abandon it at the wrong time. And so that's the best idea I could come up with to try to get people on board. And it's still not going to work, by the way, because people are still going to say one thing and do another thing. But at least if you can be as upfront as possible, and Wes Gray is really good at this. He's the best at this. Like when he's on podcasts, he's always talking about the hard things you're going to have to endure to follow their value strategy. And I think that's really important. And I think he's done a really good job of spinning it where it actually is a positive in terms of their marketing, that they're really upfront and honest about what you're going to experience. But that's the best I've come up with in terms of trying to figure out how to do it.
I think, and this lays into the investment portfolio side of the financial planning process. So once we get through the calendar and we know the things that are going to happen and when they're going to happen, approximately, once we get through the cash flows of where the surpluses and deficits are, and then ideally, once we know we've got enough surplus years, or we've already had enough surplus years, that there's a balance sheet that has a bunch of stuff on it that may or may not need to get converted back into a cash flow to pay for something on the calendar. This is when we start doing what we call buckets. These are basically risk buckets, but they're assets that may or may not have some or any need to be converted back into cash flows in the people's lifetime. Sometimes we're doing this with family offices out 2, 3, 4 generations almost in advance to try to think through how to make these assets last. The longer the time horizon, the more volatility theoretically you're willing to accept, so long as you don't have risk of permanent loss in there. And inside of that, understanding where there might be chances of needing this. So great, you started a company. It turned into a boatload of cash. You sold some of the stock, or you sold the whole company or whatever. You had to reinvest it. Or maybe the company still exists and you still have it. It might be doing great, but do you think for a second that, Jeff Bezos, or take your pick of somebody who has probably way too much of their company's stock, like there's a significant risk to their net worth if things go the other direction with a negative surprise? So we're building up the buckets on the balance sheet for clients with this stuff. Like bucket one has no variance. Bucket one in our terms is basically, that's the cash in the bank account. That's the stuff you can get right away today, and probably the cash in some of your brokerage or investment accounts, or maybe even retirement accounts to meet withdrawals, distributions, whatever. Bucket two is where we start to step out on the curve. Starts with like short-term bonds and things like that, crosses into some alternatives and whatever else. And bucket two is a rule of thumb, anywhere from like 3 to 5 or 7, sometimes even 10 years worth of surplus, worth of cash flow to plug any deficits that we might have. So 1 year's savings becomes the next year's deficit spending. And again, less volatile assets go in that because we need to know the dollar we put in is at least $1 coming back out at some point in that 3, 5, 10-year window, depending on the client's risk tolerance. And it's not until we start to get beyond 5, if not 7, if not 10 years that we get into like the third bucket and start to say long-term risks. And then we even differentiate out more for fourth and fifth buckets in some case. So we get into multi-generational planning. And then we start to ask the big questions like, how is this taxed with each generation when it's passed? Are there certain structures or investment types or other things that help lend to these types of vehicles and to help realizing somebody way down the road can use this money for something productive for their own consumption? Understanding that the building blocks of this thing are time dependent and volatility dependent. This is a huge part of the financial planning process and why it's so important to read pieces like yours and try to grasp these terms.
What you're getting at with the buckets is like a really important thing that I think is one of the best ways for anybody to manage this. And some people do it through a financial planner. Some people do it themselves. You know, we do it by kind of helping our clients if they have money elsewhere, thinking about like what works with what we're doing. And that's sizing. Like sizing is a huge part of this. You know, it's great to say, all right, look at this crazy active factor strategy. And, you know, I can't take the ups and downs, but a 5% position in it, you might be able to take the ups and downs when it works together with the rest of your portfolio. And so it's not like an investment strategy. An investment strategy does have its own standalone risk, but it's important to understand that like you have the ability to change that risk to you by looking at it in a portfolio context, by looking at its correlation with the other stuff you're doing, but also its sizing relative to the other stuff you're doing. And you can take something like we talked about in the previous episode, you can take something like ARK. If you've got a client who is a huge believer at ARK, you can take something like ARK that's exceptionally volatile and you can make it work for a client by sizing it properly in their portfolio.
The position sizing on this stuff is huge. We did that interview with Peter Mladina, Mladina. You should look it up. If you haven't watched it, Peter's one of the best, foremost thinkers on this topic. And it comes down to these two things, and understanding the relationship to whatever you own in the context of the broader portfolio. And then in these contexts, somehow time horizon matching this thing. On the academic side, a lot of this comes from the pension world or this idea of asset liability matching. And when we talk about asset liability matching, we just talk about, hey, I got to pay somebody $1 million in 3 years or 5 years or 20 years. How do I make sure that money is there? Discount it back to the present value, whatever you're going to do. How do I make sure that money is there to meet this future liability? Now, when liabilities like kids' college or retirement or third generation forward planning are unknowable, risky, right? Risky. When they're unknowable, when they are unknown, then we start to do the best version we can of going, what you explained with the strategies, what Wes explains with the strategy. What's the worst that's happened to this historically? What's the worst we can conceivably think of this? How long could this underperform? What's our risk of going to zero? How should we size that? So on this timeline, when we just might need it, even if that's a wide open window, how do we size this so that we minimize our odds of being disappointed, or to use the fancy behavioral term, regret minimization?
So this next one is an interesting one for me because it's something I've learned following Jim O'Shaughnessy and other people, which is you try to, I think all of us try to think there's too many things in investing that we would assign something close to like 100% chance to. So there's a lot of things we think will happen in the future and we think are highly likely are going to happen in the future, but it's never 100% chance. And so this is this idea of investment strategy risk. And, anyone who uses the past to try to say what's going to happen in the future in investing is sort of subject to this, that the odds are very high. Like, if you look for me, like there's never been a 20-year period where there's been 20-year periods where there was not a positive risk premium for equities, where they didn't outperform risk-free rate, but there's never been a 20-year period where equities lost money. But could there be a 20-year period where actually equities lost money? It's not out of the question. I mean, I would say the odds are very, very low, but it's not out of the question. And, in my world of factors, like I would be if you asked me to give you a percentage, I would be very confident that if I built like an intelligent multi-factor portfolio over the next 20 years or something very long, I would be confident that would outperform the market. But I also have to accept that percentage is not 100%. There is certainly a version of the world where a well-built multi-factor portfolio will underperform the market. in the next 20 years. And whenever you're investing and whenever you're using kind of the past or logic or whatever you want to use to try to figure out what might work, there's always this chance that the future is going to play out differently than you think, and it's not going to work. And so it's just something, it doesn't necessarily mean tons of changes to an investment strategy. I mean, I'm still a big believer in factor investing, but it does mean like accepting that risk exists, understanding the reality of there's a bunch of Adam Butler, when he's on our podcast, always talks about this. There's like a bunch of different paths in the future, and we don't know which path we're going to take. And so that's something I think about a lot. Just, I try to never, when I say there's going to be 100% chance of something, I try to always take a step back and say, do you really think there's a 100% chance of that? Because there's definitely always the risk, no matter what investment strategy you're following, that what you think is going to happen is not going to happen, even over really long periods of time.
I think for people who understand probability, this is where we remind them more things can happen than will happen. Like one thing will happen, but lots of things could happen. And that's why we have these conversations. When we're talking about on the financial planning front, this is a lot like you decide to book a trip to Florida or Texas or something else, like in the last month, in January or February of any given year. You're probably expecting it to be warm, and you have all the seasonal and other reasons to expect it to be warm with where you're going. But the reality is, like, at least bring a pair of pants or bring a sweatshirt with you. There's a chance you're going to get to the place you expect to be warm and your timing is just off. It was like in the 30s in Texas a couple of weeks ago. I was talking to a friend there, and it was at freezing levels. Now, the godsend was it got really cold, but it didn't snow. The whole thing didn't freeze over or anything like that. But there can be environments where a few things go wrong or a lot of things go wrong. And a big part of building investment strategies and the entire purpose of financial planning is basically thinking through, we're accepting that more things can happen than will happen. We're accepting that things are going to go wrong. And we're accepting through communication that we're going to have a conversation about what the heck are we going to do now, because this thing just surprised us.
Yeah. And I think the way it translates to me, like into building portfolios, is just thinking about like, if that risk plays out, can I live with that?
There you go.
So as an example, like if I have a more conservative strategy I can run, and I know I'm going to achieve my investing goal. I'm saying no, because I shouldn't be saying that, because 100%, I just said I can't say 100%, but I have a high likelihood of achieving my goals. But then there's a more aggressive strategy, and maybe that takes some percentage away from the chance that I'll achieve my goals and pursuing something, a bigger return over time. Do I want to live with that? Like, do I understand what I'm doing does not have a 100% chance of success? Do I want to maybe take a step back and say, am I comfortable with that additional risk? I may be or I may not be, but if I look at it that way, if I look at like my active strategy and say, there's a 100% chance this is going to work, that's not the greatest way to look at it. If I look at it, there is some chance it's not going to work. And do I need to do that? Do I think it's the right thing for me personally? I think that's a good way to look at it, when we think about this in a long-term context.
Yeah. When you think about it in a long-term context, you think about, what am I, again, not averse to taking? What am I aware of taking? And then I think you're getting at this at the end. You're going to evolve over time too. You're going to put your hand on some hot stoves. You're going to have some near misses, and it's okay for that to reshape what you're doing and what, why, and where you're doing it, because those whens act as surprises. Talk just for a second for me about the evolution of an investor through your eyes. Like, what's the evolution of an investor, or I just think of the reality that like we change as we get older, we change as we have experiences with the risks. We better understand them. Even if we're never 100% certain, I genuinely feel we better understand what it means to put these risks on. How do you see that from the investor perspective?
Yeah. And even from my own perspective in my career, I mean, to some degree, to understand these risks, you've got to see them. And that's something
100% that like what you live through is a huge thing.
And it's weird coming from like a quant and somebody who's looked at tons of academic research and stuff, because you see the risks in that stuff. You see the risks in the testing and you see the risks in the academic research, but like, it's weird. Like, until I started seeing them in my career. So like we started our models, like we started managing money in like 2005, but we started our models in 2003. And that was like just a blowout year for the type of stuff we do. Like small caps and value particularly were just killing the market in 2003. And so you come in there and that's the first thing you see in your career. You don't properly understand the risk of the other side of that. You think I'm like this genius investor, and it's me that's making these crazy returns happen. And then you realize later when you go through the tough periods that, oh, that risk is there. Like the reason I get those really good returns is because I have to endure this other risk, this long period of underperformance. And so I think it's the big challenge because the better investors for these types of things are the ones who have seen that, who have seen those bad periods and have seen the other side of the bad periods, particularly because they understand the whole cycle of it. They understand like what they need to do. But going back to my point before, for people who haven't seen it yet, it's very hard to get that across, because again, like as much as I can put documents of terrible things that can happen and back tests and all kinds of stuff, or even like actual results that somebody else saw, not them, it's just not the same until you see it with your own eyes. And that's just not just for factor investors. That's bear markets. Like, I was different after 2008, I can say. Like going through that, like that degree of a bear market, like it changes you. It makes you see a risk that you probably didn't see before. I don't know if it was the same with you.
100%. And I think you're getting to the core of something that I know I hold very dearly on the financial planning side. And that's this idea that even if you didn't have a front row seat to 2008, like I feel like I had, like I feel like you had, I didn't experience the tech bubble in the same way as I wasn't in the industry. I was aware of people trading stocks and stuff around me, but I was in high school and then college. Like it didn't register with something I could understand really in financial market terms. So when we're doing the financial planning process, this whole concept of some people I'm thinking of, like Brian Portnoy and our friend Daniel Crosby and some other people talk about like, tell us your money story. And it's this idea of like, how do you unpack your relationship to other things with money? And I know as a practitioner, what you just explained becomes a huge part of my conversations with people. It becomes a huge part with you may not have lived through the last 17 bear markets or whatever, but you've lived through things in life and you have an emotional relationship. You have feelings you have actions that you've taken on these things. And the part of the planner job that comes sometimes right up to the line of like therapy without crossing that line is to actually start to help people unpack what are their attitudes towards risk? What are their attitudes towards feeling true fear, true discomfort by a situation, and then translating that through, okay, when a financial asset is doing this to you, when a job loss is doing this to you, when the medical bill for your spouse is doing this with you, these are all real things that we grapple with in financial planning world. And they're not bear markets, but they're related to bear markets. They're not literal underperformance sometimes, but they're related to relative measurements of underperformance. That relationship is completely in our heads. It's completely in our social fabric. And getting it out of your head to understand how a job loss or the business your dad ran that went out of business or something, that can be informative to the investment strategy you take and put on. The better each investor knows thyself, the more equipped we are to understand, back to what we started on. Don't be risk averse when you're making the conscientious choice to be avoiding of that risk, but be risk aware when you know you get into something and all the ways that's going to play with your head, play with your heart, mess you up as you're living through it, because you are going to change as you experience new things and you figure out what you're made of.
Yeah, that idea of how you like think about risk in your life is a very interesting one because there's certain things you go through. You talked about job losses and stuff like that. There's certain things you go to that I think are probably very applicable to like the financial world. And then I think it's Daniel Crosby that's done some stuff around this. Like there's other stuff that's not. Like for instance, I'm not going to go bungee jumping no matter what. Like there's no chance I'm doing that. But I can take tons of risk in financial markets. So like that type of thing, like that physical risk the fact that I'm risk averse in one, doesn't mean anything for the other one. But like other things, as maybe they tie more to finances or to your life, maybe they do tie in. So it's interesting. I don't know if there's, you may know, I don't know if there's tons of research around that, but it's interesting to think about like, what are the types of things you can look at in someone's life to look at how risk averse they are and maybe translate it to how they actually handle their money.
There are some studies of this stuff. I don't want to going to be respectfully skeptical on saying there's one thing that's constant, because I think the only thing that's constant here is that we are ever evolving people. And the minute you try to tamp it down into something super structured, you're going to lose the script. I think about this a lot with like, you know, Myers-Briggs personality tests and all that type of stuff. And this stuff is good. It's informative and useful, but we have to accept the fact that we do change with experience over time and different periods of life. There's a huge sequence of returns thing. There's a huge difference between, as an example, losing your job and losing your job in a bear market right before you retire. Like if you get laid off and you're 24 years old and I'm thinking about like the beginning of COVID. There's a huge difference between, and not to make anyone's job loss like lighter than someone else's, but if you were a 26-year-old waitress at a restaurant and, hey, young man, guess what? Like you can't get your tips at the bar. So it sucks a little bit, but we're going to pay you to stay home because it's not safe out there and whatever else with your unemployment check. You feel that a lot less than like the 65-year-old bar owner who was thinking about retiring in 2 years or something, whose whole business just went to hell and now has no clue if they're going to recover. The whole how these risks map, they evolve. We have to know enough of how we stack those tolerances on top of each other. That's really, really important. But we're people. So we live through life. Life happens over time, and experiences also get popped in and out of order, just like sequences of returns. And I think that's the most important thing. Like you, I don't go bungee jumping. I'm not a lottery player. I hate gambling. Like I literally can't handle walking through casinos. I get almost like physically ill doing it. Something about it just drives me crazy. So it's great. I have a bunch of risks that I know I like to be averse of. The minute I'm standing on a bridge and somebody starts putting a belt and a bungee cord to me, I'll be like, yeah, no, I'm out, not for me. But yeah, I think it's super interesting. Neil Bay should be a great person to ask on this too. He actually has designed some really insane software and other things for helping measure this stuff. I got to ask him what he thinks the differences are on this topic.
Well, that kind of gets at what I wanted to ask next, which is, do you think, there are places out there, where you can sort of take in the information for a client and try to boil it down to like a risk score. What do you think about that? Do you think that's helpful? Do you think that can be done? I'm just curious, that doesn't apply to us as much on the investment side as it does to you on the planning side. So I'm just wondering what you think about that whole idea.
So this is interesting. And my partner, Michael Pompion's had some really fascinating stuff to say about this. He says that we have types inside of us, and then those types help explain some of our naturally predisposed biases. Those do evolve over time. They're not constant and fixed forever. So we want to understand where they are, or take tests, surveys, whatever, to reassess our current stance at different points in time, especially like red flag. If you're feeling something extra, it's a good time to take an assessment. Only if you follow it up with another time when you're not feeling anything to take the assessment, and then kind of compare and contrast the two against each other. So there's useful information in getting this stuff, but they are very context dependent towards how you're feeling when you take these things. So it's great if you can have a risk number, but I think better than just having a risk number is understanding the risk number as it maps to, again, the buckets on your balance sheet. And now when I step back and go, okay, maybe I'm a 10 out of 10 risk, and we work with clients like this. I'm a 10 out of 10 risk because I'm all venture capital and crypto and something else all the time. Made a ton of money, benefited wildly from these things. But guess what? With all those people, it's what I think of as is the Jesse Livermore treatment. When you're taking super high risks, then you also need the Nassim Taleb barbell of some ultra low risk stuff to pair with it. And at some point of time, something in life tells you, oh, I can't just go pedal to the metal all the time. I got to put this other thing in place. You've read, I'm sure everybody's been required to read Reminiscences of a Stock Operator before.
Yes. Not it was a long time ago, but I have, yes.
Yeah, it's been a minute for me. Love the book, multiple reads, way dog-eared and highlighted wherever my copy is, somewhere in here. Do you remember like what he did after the first maybe after the first time he blew up, like the second time he made a ton of money. Do you remember what some of the, like the first things he did? It's one of my favorite parts of that book is like in the recovery phases. And some of this might even be outside of the book. Do you remember what he would do?
It's been so many years that I'm sure you do because you remember all
He-
this stuff, but
He bought, and granted, I say this word in giant air quotes because don't take all the bad words with it. Like he bought annuities for his wife and for his family and other stuff. So after losing everything, the ultimate quotable risk taker that we all talk about all the time, anybody who does trading like reads Reminiscences of a Stock Operator and celebrates Jesse Livermore in some way, he realized he had to barbell this strategy. He couldn't be ultra high risk. He knew he had degenerate gambling tendencies when he got involved in this stuff. And so he made sure his wife and his family had this lifeline by purchasing some annuities and other stuff that he literally couldn't touch. So he could go out there, maybe make a ton of money, but also maybe bankrupt himself again. And he wouldn't destroy the people that he cared about in that way. We just turned that up to 11 to get to that scenario, but it's useful for people to understand that construct to say, I don't need a risk number per se. I don't need the TV ad, green arrow telling me where to go. I don't need to be taunted that it's so easy a baby can do it. The reality is you got to figure out how you're going to make peace with the things, with the risks you are aware of taking. And for the stuff that's not worth taking, don't put the bungee cord on. Be risk averse. It's fine to be risk averse about some things so long as you have a map to reach your goals.
yeah. And so this, I think what you said is kind of the way I think about it too. Like it's great to attempt to quantify risk. And I actually think there's some value in trying to quantify risk, whether it's a risk score on your side or like one of the things we've tried to do is when you run active strategies, you kind of think about like, if someone follows this active strategy, what's going to derail them? What's going to make them not successful? And so in our world, what is that? Like, well, when they underperform, that's probably going to make them not successful if they abandon the strategy. Well, the longer that underperforming period gets, the more likely they're going to abandon it. Or the deeper that underperforming period gets in terms of how far they are behind whatever benchmark they're judging themselves against, that's probably going to derail the strategy. And so one of the things we've done is we've built some of these combined numbers where we look at like for every strategy we run, we look at every rolling 12-month period and say, how many of those rolling 12-month periods was this strategy behind the benchmark? How many of those rolling 3-year periods was it behind the benchmark? How many 5-year periods? And then what percentage, if a client was sitting there at any given day, just a random day, what percentage of the time would they be at least 5% behind their benchmark? Like over the previous year? What percentage of the time would they be 10% behind their benchmark over the previous year? And those are all random numbers, but when you think about that, those are all things that generate pain for investors. And so that's something I've worked on behind the scenes is like coming up with a score that kind of combines those things together not of the people, but of our strategies themselves, so that I understand like how much pain is this particular strategy going to cause someone. So then I can match that with somebody who can endure that type of pain. And it's definitely an inexact process, but it gets at like thinking about what's going to cause people to fail and then trying to put a number to those things that are going to cause them to fail and then matching it with the right person.
I think the most useful part about what you said too is if you understand that, I'm going to call it underperformance risk, some type of like performance volatility targeting thing. If you understand that of each strategy, that's what capital market assumptions are. That's how we build portfolios. So even if I'm not having this conversation with a client, we're doing it behind the scenes. But then you understand how those things stack together. Along the same terms, the other thing, and we kind of capture this at a high level, and so I don't want to diminish this, but there's almost always a function of when you combine things of some type of like volatility targeting. Do you ever think in terms of that, like managing to a volatility target? I know there's that's probably a whole other episode where we just talk about vol targeting strategies, but do you ever think in terms of that?
We don't do a lot of it. I mean, we do look when we're kind of combining things together, we do take get an idea of what kind of volatility we have. And certainly when building multi-factor strategies, combining them to try to reduce the volatility, but we don't, I think that's more in the multi-asset world than it is like with us in terms of like the volatility targeting. We know, when you're doing active factor investing, you're going to have fairly high levels of volatility. So we pay attention to it, but it's not something we spend a ton of time on.
So I think I'm ready for my pop culture reference, and maybe this is what we go out on today, Jack.
Yeah, let's do it. We can't end. It's a rule. We can't end until you do it. So
we can't end until we have some random pop culture reference. I think there's nothing better in a conversation about risk to remind us all of the moral of the great philosophical tale, Risky Business with Tom Cruise. Are you familiar with this Stoic masterpiece?
Yes.
So I think the takeaway of Risky Business is, remember, somebody always has to be compensated for taking risk, but sometimes the volatility you get is not the volatility that you bargained for. When Tom Cruise's character is, running the house party full of like prostitutes and high school kids, I think, which is, totally normal for 1980s teenagerhood. That's probably not the risk anybody was bargaining for. And that's why at the end of the movie, when they're having the conversation and it's, high school student off to fancy college talking to local, Chicago prostitute, the conversation is like, hey, we should get together again someday. And Tom Cruise's character proves the ultimate lesson in basically saying to her, that's going to cost you. You take risk. You got to know who's paying for it.
I think that's a good thing to wrap up on. Thank you, everybody, for joining us, and we'll see you next week.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.